Welcome to Bloomberg Markets. I'm Sonali Basak, and the S&P 500 hitting a record high today, one day after the Fed starts to cut rates with an aggressive first move. This hour, we're going to have an all-star lineup for you that includes exclusive conversations with Carlyle's Jason Thomas, followed by JetBlue CEO Joanna Geraghty. And later, we're going to talk fintech and mobile payments with Affirm co-founder and CEO Max Levchin, followed by Naftali Group Chairman and CEO Miki Naftali, covering luxury and commercial real estate, of course, an area that would be very impacted by interest rates. Let's get a check on these markets because, like we've said, we've been hitting a new record high today in that S&P 500, 1.6% higher. But it's really big tech. You're even seeing the bigger rally there. That NASDAQ 100 now up by 2.6%. These moves really holding into the midday trade. The Russell 2000 now up by 1.7%. Interesting part of the market here, as it was up a lot more earlier in the day. However, still up nonetheless today. And the 10-year yield now about 373 on the day. The movement in the bond market has been drastic. Earlier in the day, we saw a 6 basis point move higher, and we have seen that diminishing. We're going to dig further into today's market rally with midday movers with Abigail Doolittle. Abby.
Well, one of the areas that's really being lifted up by the 50 basis point rate cut, Sonali, this risk-on mood, animal spirits being stirred. The crypto space, take a look at these crypto ETFs, Bitcoin and Ether and Coinbase in there too. So one of the stocks related, all really sharply higher, up more than 5%. So some of the liquidity that had come out of these risk-on areas now going back in, suggesting that maybe this rally has more to go. But it's interesting because it's not just crypto, it's not just technology, it is also the banks. Now, this is super interesting. Yes, we do have yields up a little bit today, so that would help the banks. You can see the KBW Bank Index and then the Regional Banking Index. I think that maybe something else going on here, though, is if investors are thinking now the Fed is lower for longer, well, that could, in fact, help lending activity, even though it might hurt on some of the interest income to some degree. And then finally, I was mentioning technology, not up as much as crypto, but we do have a nice rally here for the S&P 500 tech index. And then, of course, communication services that houses, say, your Googles and your Metas. Consumer discretionary up 1.9%. Tesla's in there. And then the stocks, the real tech winner of the day, chips, NVIDIA being one of them, up 4.6%. All of these areas really having the best day in a month to 2 months, Sonali. So a very nice rally.
Abby, thank you so very much. We're going to get back now to that historic 50 basis point rate cut by the Federal Reserve. The move is spurring market bets for more rate cuts, despite Fed Chair Jerome Powell saying that the Fed has not yet committed to further cuts this year, at least not to that extent. Joining us now for an exclusive interview is Jason Thomas, head of global research and investment strategy at the Carlyle Group, who has had a long career in Washington as well. So you're very close to the matter here. And it's interesting, in the note, the white paper that you've put out today, you make this point that before we got into this rate cutting cycle, there was kind of, let's call it a complaint, though many people had benefit from it, this idea of kind of unnaturally low interest rates. Now many investors believe we've been sitting with unnaturally high interest rates. So what does equilibrium look like?
Well, thanks for having me back. Yeah, I think right now the sense that these rates remain, even after the cut, unnaturally high is really very reminiscent of 2012. That year, you had many investors, many very prominent investors, insisting that we're in the midst of a massive bond bubble. They looked at 0% base rates, 2% bond yields. The price of some long-term government bonds were over nearly 2 times face value. And they insisted this would all collapse once the Fed stopped buying bonds. Then the following year, Chair Bernanke surprised markets with the suggestion that the Fed could taper. Of course, the Fed followed through, completely winding down QE. And then a surprising thing happened. 10-year U.S. Treasury bond yields were basically the same after the Fed ended QE as they were at the time Bernanke first surprised markets. And then that led to people turning to fundamentals to explain very low interest rates. That's when concepts like R star started to enter the lexicon. And I think we may experience a mirror image of that over the next 12 months. I still think rates are too high. I think there may be 2 more cuts coming. But after that, you could see the reemergence of price pressures. You could see backing up of bond yields. And then people are forced to again turn to fundamentals, change fundamentals, fiscal deficit, changes in trade policy, a fixed industrial investment boom, of course, tied to AI, green industry, to accept that perhaps 4%, 4.5% base rates is the new normal.
So that's an interesting basis point to really stand on here, an interesting basis to stand on, 4.5%. How fast do we get there? And do you think that once we get there, what are the risks to it?
Well, I think that first, it's important to note that the Fed has done its job. And when inflation declines, a central bank that doesn't cut rates is effectively tightening policy. No one today could think that tighter policy is appropriate for the U.S. economy. So this is entirely reasonable. And I think there are certainly more rate cuts in store. But I just suspect that the room to cut is somewhat smaller than currently implied by the futures, by the yield curve. And so what I think is, for example, if you look at the decline in the forward curve and the decline in mortgage interest rates, I mean, you could have over a 200 basis point decline in U.S. 30-year mortgage interest rates from the peak in October. And if that's the case, one could imagine a really big pickup in transactions, a pickup in fixed residential investment. And so some of these sectors that had been depressed by these high real interest rates could pick up in a way that all of a sudden we're at the end of the year, that there's certainly the Fed's not going to be positioned to hike, that's not coming. But this enthusiasm for incremental rate cuts could really slow. And I think it could happen faster than many market participants suspect.
As you kind of pointed out here, Jason, there's a few factors that could really complicate the cutting cycle. You've mentioned the fiscal pressures. You've mentioned trade frictions. You also have been talking about this CapEx boom, this industrial spending that we're seeing going on. You call it a manufacturing renaissance of sorts, particularly driven by the AI enthusiasm. How do you think that really plays into the inflation and rates story here? Draw the line for me.
Sure. So I think when we look back at the disinflation that we observed that allowed for base rates to be as low as they were, first, the fiscal situation. Yes, the fiscal deficit this year, 7% of GDP, roughly the same as it was in 2011, 2012, when base rates were 0. The big difference, however, is that deficits after the GFC were so large because the economy was so depressed. You had very low tax receipts, very high social services spending. If you adjust for the state of the economy, the deficit today is 2.5 times larger. As you remember, after the 2010 midterm election, there was no appetite for additional fiscal stimulus in the U.S. The Fed was called the only game in town. Today, the situation is quite the opposite, with the Treasury injecting about $1.5 trillion of incremental liquidity in the economy relative to back then. The Fed is in more of a reactive posture, having to keep rates higher than would otherwise be the case. As it relates to trade, I think it's self-evident. If you restrict imports of things like Chinese EVs, Chinese solar modules, this is understandable, but I think it's unreasonable to think there's not going to be trade-offs, which is to say there'll be less disinflation than would otherwise obtain. And then finally, as it relates to this fixed industrial boom, you have a big change. And again, during that period, the decade after the GFC, corporate savings, corporate cash surpluses were so high because reinvestment rates were relatively low. Companies moved to asset-light business models. Today, when you see that big increase in CapEx budgets at the hyperscalers, mega cap stocks, when you see this very large boom in green industry, construction of battery plants, EVs, this is really requiring a lot of societal resources. And it's again, changing the inflation dynamic. Interestingly, you have construction employment. If you compare it to overall trends in payrolls, it's actually up about 20% relative to the economy as a whole. That's surprising, given that there's very little office construction, of course, given that there has been this downturn in residential investment. And that's virtually all explained by data centers and then by these other industrial facilities. So again, these are big changes. And I think that we're just going to return to 2019 levels of interest rates, it really requires one to ignore the scale of the changes that have been observed since then.
Jason, you work for one of the world's largest private equity firms, so very natural for me to want to ask you, what does the rate cutting cycle mean for future investment and M&A in particular? There has been a whole market waiting for years for this buyout market to return and the exit market to return at scale.
Yeah, I think it's very good news. I think that, first of all, when you look at activity in M&A, you saw a very clear increase in the sponsor share of M&A, which means that most of the decline in the overall M&A volumes is attributable to a decline in strategic acquisitions. So companies have been sitting on the sidelines. I think a big part of that was that many management teams were prepared for a recession that never happened. So starting in 2022 into 2023, there was some degree of conservatism among management teams. Then when that recession didn't occur, they actually saw an increase in earnings, widening of margins because of that conservatism from the prior year. Now, to continue that earnings growth, they're going to have to start to look to acquisitions. I think now that the Fed has finally cut rates, there is more comfort about finance costs. And so I do think you're going to see a pickup in exits, and I think it's going to be led by these trade sales, essentially selling the sponsored business to strategic acquirers.
Jason, we thank you so very much. And of course, Jason is out with a new white paper on all of this investment and his view on rates. Now, I want to bring you guys some breaking news as well, because the Wall Street Journal reporting that hedge fund firm 2 Sigma is in settlement talks with the SEC. The Journal reporting that 2 Sigma is likely to pay as much as $100 million to settle an SEC investigation into a trading scandal at the firm. And the firm would likely face blame for how it oversaw an ex-employee at the center of misconduct. We will bring you more as we know it. Now, coming up, JetBlue CEO joins us for an exclusive interview to discuss the company's new plans for profitability, even amid headwinds in the travel industry, and a check on airline stocks amid this rally. Names gaining more than 1%. Stick with us. This is Bloomberg. And JetBlue is out today with some plans on operational revamp in an effort to turn to consistent profitability for the struggling carrier. And Bloomberg's Lisa Abramowicz is at the Skift Global Conference, a travel industry conference, and she's actually standing right by with JetBlue's CEO. Lisa.
Sonali, thank you so much. I am here at the Skift Global Conference right across the street from all the cruise liners, and beautiful trips and plans that people could take, but we are not today. I am so pleased, though, today I am sitting down with someone who really has seen quite a transformation, Joanna Geraghty, who is the CEO of JetBlue, joining us here. And you've been at this company for almost 2 decades. Mm-hmm. You became CEO in February. Yep. You previously were Chief Operating Officer. Yep. This has been a company that's undergone an incredible transformation. Yeah. Can you just describe what that transformation of identity has been like?
Thanks for the question. JetBlue, our mission has always been about bringing humanity back to air travel. And I think we continue to do that to this day. We've definitely had a number of challenging items over the last few years, a failed transaction, actually failed 2 transactions. But we're focused on getting back to the core, our roots, what makes JetBlue unique, special, being that carrier for so many different customers who want to fly to leisure out of the Northeast into the Caribbean, Florida, you name it, but really remembering that at the heart of what we do is deliver great service. We've got great people, and that's what sets JetBlue apart.
The reason why I ask is because you made some news today. You talked about opening lounges at JFK in New York City, as well as in Boston's Logan Airport, some plans to potentially open up others in Orlando and Fort Lauderdale. And it made me think the idea of lounges caters to a premium, well-heeled customer. How does that fit into the transformation?
Yeah, I think most probably don't realize that JetBlue actually, about 25% of our seats are premium between our Even More Space seats and our Mint product. And this has been something that customers have been asking for quite some time. And so we're dipping our toe into the water. Boston, JFK, the lounges are going to be designed around a more bespoke personal experience, play, live, work, and really focusing on how do we address what our customers have asked for. Transatlantic customers will be able to go into the lounges as part of their ticket. Our Mosaic 4 customers, so some of our most loyal, will also have access, along with our customers who are going to sign up for our new Premier card that we're launching later this year. But we're focused on making sure there's no long lines, and it's something that customers actually want to enjoy before they fly.
Okay, let's just talk about how many lounges you're talking about building out. I mean, is this the beginning of 15 lounges all around the world? You're talking about London, you're talking about New York, or are you talking about, let's see how it goes?
Let's see how it goes. I think if you look at what we did with Mint when we introduced it across the United States, about years ago, we were very thoughtful about how we stepped into it. We want to make sure that it's what customers want, but we also want to make sure it's affordable. And lounges are expensive to build them out, to operate them. So we've got to be very thoughtful because low fares are an incredibly important part of what JetBlue delivers to customers, and we need to keep it that way.
Well, that's what I was going to ask. I think about lounges and premium seats as often catering to a corporate customer. How do you cater to the leisure customer with these types of perks that cost money at a time when you're really known for catering to value for people like myself who have gone to the islands with the kids and pack it all up and it's exhausting, but they can get sun chips so everybody's happy?
Sure. I think what most don't realize is our loyalty program and becoming a Mosaic 4 is actually quite accessible. So unlike some of the larger carriers where you have to be a true road warrior to take advantage of some of the perks, that's not the case at JetBlue. You book a couple vacations a year on JetBlue, and depending on the flight spend, you might actually qualify as a Mosaic 4, and that gives you a right into a lounge, which I think is unique and sets us apart. There's this huge population of people who fly a lot, but not enough to probably qualify to be, the top tier at some of the other airlines, and we want to be there for them. We know we can do it in terms of the onboard service. We do it today. Free Wi-Fi. We've been doing it for 10 years. You can stream. You can play games, snacks, great leg room, and I think we're uniquely situated to do this.
Since the pandemic, people have talked about how a lot of airlines that have catered to a wealthier individual have been more resilient. They've been able to withstand some of the turmoil post-pandemic and during the pandemic. There has been a surprising trend that has stuck, that people are willing to spend money to have extra legroom for a premium seat, even slightly better food. How resilient is that trend? Is that here to stay, and why?
We've been seeing the premium trend for the last 10 years. It's why we introduced Mint several years ago, but we want to be careful about it because we don't have the road warrior customer, but we know we have a high-value leisure customer. And so when I think about the girls' trip to the Caribbean, you want a special experience. You want, a fun drink. You want a little extra legroom. You want to be able to stream on your phone. Those are things that we can offer, and there's a great customer demographic to do that. But we also have to remember some customers don't want those perks, and low fares are a real priority. So we want to balance it all. An aircraft is a tube, and we think that there's a whole bunch of different things we can offer within that. But you have to be mindful of how many customers you're going to cater to in each section of the aircraft.
How expensive are these lounges?
So we haven't gotten into costs. We're not talking about that publicly, but we're going to do it in a very affordable way. And it's very much tied to our transatlantic service, our co-brand partner, as well as customers who want to buy day passes that are a part of our mosaics.
You mentioned the credit card that you're going to be unrolling, and I've seen this with Delta and United and how the credit card has been the key component of a lot of their resilience and profitability. Do airlines now have to be credit card companies to survive?
I don't think they need to be credit card companies to survive, but it definitely helps. Listen, a credit card that is associated with an airline keeps the brand top of mind. When you take it out to buy a meal and you get points on JetBlue, that's something that reminds you that those points are there to earn travel for your next experience. And so from our perspective, we have a great credit card program, a great partner in the form of Barclays and MasterCard, and it's something that we know we have opportunity to continue to grow, tied to our loyalty program. We also get points on vacations with JetBlue, and that's something unique. Avis as well, rental cars. So we like how we've designed the program really around the leisure customer and the perks that they want as part of that program.
So you haven't transformed any of the locations that JetBlue flies to in terms of spreading out beyond just leisure? Is that really still the focus?
So right now we're focused on really trying to make sure that we're growing our points of strength. So our focus is being the best East Coast leisure network, Boston, New York, the surrounding cities down to Florida, the Caribbean. We've got some great transatlantic flights. We definitely have to make sure in this world where we're not growing as much that the places that we fly earn their way into the network. So we've moved some unprofitable flying out. We've actually pivoted pretty significantly back into the Northeast and really doubling down on offering a great schedule and a great network for customers here.
There have been a number of changes. In February, Carlyle Group took a 10% stake, or just under that, in JetBlue. And he has two board seats that he has filled. How many of these changes are coming with his urging?
So this is very much a plan that JetBlue has had in place. We've been working it for the last year as we were kind of cycling through the Spirit transaction. The Carlyle Group board members have been very constructive, and we all feel very strongly that we need to become profitable again, and we need to remember that we have these tremendous strengths that we need to drive more value out of.
You mentioned that Spirit deal. You mentioned a couple deals that have fallen through. We did see Alaska and Hawaiian tie up. Are you still out there looking to consolidate, or are you just basically saying, that's enough, we're done?
We've got a great brand. We've got a great organic plan. We're focused on delivering the organic plan. Going through a transaction can take its toll on an organization. It also creates a level of distraction. And so we're very much focused on executing our Jet Forward plan and bringing JetBlue back to what it was when we were founded, around bringing humanity back to air travel.
Is there a certain critical mass, though, a certain economy of scale that's required in a world where the overhead is getting more fickle and more volatile? And frankly, a lot of people, the staff actually are a lot more expensive. Mm-hmm.
I think scale matters. We're trying to build that scale within our core geographies. So again, if you look at what we're doing in the Northeast, it's building scale and schedule and depth in the Northeast, in the Caribbean, in Florida. And that's our focus, is if we can't build scale on a national level, let's build scale in the geographies where there are high populations of people, where our brand is well known, where customers love the experience, and where we can deliver a great leisure offering to customers.
There's a question right now about how long we can remain in this cycle where people can really lean into the Instagram moment. And I'm wondering how much you see ongoing spending, or whether some of the new offerings really reflect the fact that spending has been strong in the upper income tier and has been tapering off in people who are looking more for just value.
You know, customers definitely look for value, and we need to be there for them, which is why low fares matter. But we also know customers value experiences too, and we're continuing to see strength in interest in those experiences, and we want to be the airline to do it for the leisure customer.
Do you need to increase prices significantly to keep up with the pace of how much things are increasing, especially given, some of the renewed contracts and how, the overhead costs have reportedly gotten significantly more expensive?
We're definitely seeing labor costs increase, and it's important. We want to pay our people for the service they deliver. They're an important part of the JetBlue product. They're what differentiates us, but we also have to be mindful that we have to keep our costs in check. And that's always been a key priority for JetBlue, because low costs drive lower fares. We're focused on how do we do that through data science, running a more efficient operation. We've seen great progress this summer in terms of better operational performance, and that drives costs out of the business.
Do you see demand sort of level, picking up? How would you characterize it?
Yeah, I'd say demand, as we communicated in our last update, is solid. The fall troughs are definitely more challenging. The troughs are a bit deeper for the leisure customer now than they were pre-COVID. So we're focused on rationalizing capacity during those troughs to drive the best results for JetBlue.
What's your favorite route?
Oh, that's a tough one. They're all my favorite.
Oh, boy. All my children are my favorite children. Joanna Geraghty, thank you so much for being with us. Joanna Geraghty, the CEO of JetBlue. I'm going to throw it back to you now.
Lisa, we thank you so very much. What a great interview. That is Bloomberg's Lisa Abramowicz and JetBlue's CEO Joanna Geraghty at a time of transformation for the industry. Now let's get a check on markets here, see where things are. Of course, on the heels of that historic rate cutting cycle just kicking off, you still have some significant gains here, not only in broader markets, but in a ton of finance and financial technology stocks that would have otherwise been very closely tied to interest rates. You have Affirm, PayPal all up on the day, along with the larger banking sector also higher. S&P 500 up around 1.8%, and the NASDAQ 100 resuming gains of almost 3%. And you are seeing the two-year yield around 360, just down a little over a basis point, and the 10-year still up by 3 basis points. Now, coming up, Affirm is seeing gains on the heels of some major announcements this week. We're going to talk to the CEO, Max Levchin. He joins us next. This is Bloomberg. This is Bloomberg Markets, and I'm Shonali Bassick. Let's get a check on the markets here. The S&P 500 have hitting records today after that historic rate cut by the Fed, 1.8% on the day higher. NASDAQ 100, even more so, almost 3%. The Russell 2000 up almost 2%. It's not as high as it was earlier in the day, but higher nonetheless. And the 10-year has a rise in yields of about 3 basis points, surprising after a rate cut, but interesting moves under the surface that we will keep an eye on. There's one stock that's really been moving over the past 10 days that we're keeping an eye on, Affirm, around 15% higher over that time frame. It's the highest it's been since February. And Affirm this week announcing that U.S. Apple Pay users can buy now and pay later for as low as 0% APR. The new agreement will allow users checking out online or in-app with Apple Pay on iPhones and their iPad to be able to pay over time with Affirm. And we are joined by none other than Affirm's co-founder and CEO, Max Levchin. How does this change the game for you? Because obviously a lot of users use Apple Pay. Apple's own entry into financial services has been a massive wonder of the industry, to say the least. But now the addition of buying now, paying later through Affirm, what is the expectation here?
It was just really exciting. It's, first and foremost, it's unbelievably great to have direct integration into a, really best, in my biased opinion, I'm sure, digital wallet out there. Super early days. We've been live for 3 days, so don't ask me for results just yet. But the actual implementation is wonderful, and so I'm very excited about the possibilities here. Obviously, it's going to be great for consumers that love their digital wallet, but it's also going to be amazing for retailers. It's just in time for the holidays. You'll be able to use your Apple Pay Affirm integration to buy gifts, to affirm all the things you need to have for your loved ones, etc. So just really excited about the possibilities.
It's interesting. You and I are old enough to remember years ago when I was bothering you left and right about what it would mean for Apple to get into buy now, pay later. And now they're partnering with you. There was a time where people would worry about whether that would create a significant competitive force. The way the landscape is shaking out is through partnership in this massive way with the giant tech companies. How do you expect that to continue to extend? Because it seems like a pretty massive change from what we saw a few years ago.
It's still a very young industry, and partnering well is what we have become known for. We count the largest retailers, the largest platforms, some of the best known brands in the world among our partners, and it's always for the same very basic set of reasons. We treat both sides of the customer ecosystem right. We don't charge late fees. We don't hurt our consumers. We're very careful to say yes and no when we don't believe someone will pay us back. And we really deliver value for retailers. We increase their average sales. We help them drive conversion at the point of sale. And so those two things combined make us the ideal partner. And it helps to be built by very serious computer scientists, which means that we can scale with volume. The spikes you see during Black Friday and the holiday season are pretty significant technical challenges, and we're just very, very good at it. And so that's why we're picked by the best brands out there to be partnered with.
Another aspect of this is you have seen some of the retailers you work with, some have had some knockout numbers in the last couple of months, but others have really faced weaknesses in the consumer. And if you think about the path forward here with that interest rate cut, how does that really change the game? Do you expect consumers to still be this bifurcated in the market? Do you still expect significant weaknesses until we see a much more significant level of cuts?
If I could predict macroeconomic events as well as that, I probably would have a very different job. But Affirm consumer is buying and shopping. We just reported numbers a couple of weeks ago. They look very strong. We are forecasting a really great growth going forward in this fiscal year. So cautiously optimistic. U.S. consumer is shopping. They're buying. They're paying their bills with Affirm. And so that seems to be going well. The Fed lowering the interest rate, obviously, among other things, suggests the Fed is worried about too much of a slowdown and that their war on inflation has now been all but won. And so, I'm in a cautious posture relative to U.S. consumer. That said, we're seeing great demand.
What are you expecting for the holiday season? You were talking about that a little bit before. You were talking about how you expect people to pay for their holiday shopping on Apple Pay with you guys, among other things. What do you think will happen this holiday season relative to years past, from what you know?
This may be an easy prediction to make, but I'm relatively sure this holiday season will be the greatest number of people affirming their gifts ever. That's my prediction for our business. I do expect there to be a significant amount of AI curated gift lists. I think that's a big new thing, and there'll be a lot of attempts to drive people's buying with just a more curated experience, which now can be done using generative AI. So I'm pretty excited about that. And then I do see already early in the holiday shopping season, retailers coming to us and saying, we would like to subsidize the interest that consumers might pay in these loans. And they choose to essentially offer zero interest loans, zero interest financing plans that we power, of course, for everything from 4 weeks to 4 years length. And so I see a lot of that coming, which will be amazing for consumers. Being able to take more use of money over time without paying any interest is pretty awesome.
Glad to hear you talking more about Gen AI, because the last time you and I have talked about it, we were kind of talking about the limitations and, kind of the more boring use cases, let's say, when it came to AI and Gen AI and financial technology in particular. What's changing, especially because you dovetail with the world of e-commerce so greatly?
So I think it's becoming more and more user-friendly on the consumer side. And I think AI shopping assistants and all the various things that retailers are pouring resources and genuinely excited about is pretty great. We don't talk a ton about it because we want to be very careful to bifurcate. We do not use Gen AI for underwriting. That is something that has to be very predictable and cannot hallucinate, so we stay very far from that. We do use it for productivity enhancements internally with really wonderful effects. I keep on shipping these really cool new ways for our consumers to quickly get to the right answer when they're contacting us for customer service purposes. We're also looking at all sorts of acceleration in our development schedules because we're able to use these Gen AI tools. And so there's a lot to be excited about. Just, like every new technology, you have to be appropriately careful in use cases that you don't fully have control over.
Max, back to the consumer for a moment here, because you and I talk about this a lot, the credit card uptake in the country right now. People have been maxing out. We are near record levels of credit card balances across really the spectrum of America. And then you also have rates above 20, often 25% APRs. How fast does that come down? And, even if you can't tell me how fast, or if you can't, then what is the relationship between how people use buy now, pay later and amass credit card debt?
So from my point of view, and I'm biased, so I'll talk my own book for a second. We are the right alternative to credit card debt. If you are borrowing to pay for things over time, which all of us do, from education loans all the way to holiday gifts, you are better off not revolving, full stop. When your interest compounds into principal, you are paying on an exponential curve, and that is what credit cards do for you. And so I am genuinely concerned for credit card balances growing, less because of the absolute number of these balances and more because of the type of debt that they're generating. It's the debt that can run away and does run away from people. The reason buy now, pay later, the reason Affirm in particular is such a good alternative is, in our case, not just that there aren't any fees and there's no penalties and there are gotchas. The interest doesn't compound into principal if there's any interest to pay at all. It is very reasonable to stretch your budget by paying over time. It can be dangerous if you revolve on that debt and have no idea how you're going to pay it off. I sometimes call credit cards buy now, pay forever for exactly that reason. Buy now, pay later is a safer alternative.
Max, we have to leave it there, but of course this is a much longer discussion. This is going to change very quickly, this world, in the next year or so. That is Affirm co-founder and CEO Max Levchin. And coming up next, we're going to talk about banking. We're going to talk about the changes at the top of TD Bank. Who's in, who's out? We're going to have the details on that next. This is Bloomberg. This is Bloomberg Markets, and I'm Shonali Basak, and it's time now for Stock of the Hour. Toronto Dominion Bank said that CEO Bharat Masrani will retire in April, and Raymond Chun will take the top job. This comes as the bank grapples with investigations by the Department of Justice in the United States and financial regulators into lapses of money laundering controls at its U.S. branches. For more, we are joined by BNN Bloomberg's Jon Erlichman in Toronto. And let's talk for a moment about what got us here, because of course these have been significant regulatory challenges, and the outgoing CEO has now said that he takes full responsibility. Does changing the guard help to fix these problems?
It's being debated in the stock market right now, Shonali, as investors watch TD's stock price today. It's a great question. There have been questions swirling for months on what the succession plan at TD Bank would look like. And just a reminder for audiences, while technically Toronto's in the name and they're based in Toronto, obviously, if you think about this bank, it has grown an extensive footprint in particular in the northeastern part of the United States with a big retail presence. But they are still navigating through, to your earlier point, these money laundering investigations tied to some of their U.S. branches. If you go back to August, TD had put a price tag on what they think this will ultimately cost them, and it is into the billions of dollars. But there was still this question of, well, who's going to be the next leader of this business? Because Bharat Masrani has been in this job for more than a decade, so the question of succession was already on the table. And at this point, we're still unclear on when all the investigations wrap up. So there's a general view on the street that this announcement today, that there's a timeline for him to transition out of this role, that he issued essentially a mea culpa because this has happened under his watch, and they can name a successor. It's an internal candidate. Ray Chun, who you referenced, has been with the bank since 1992. He's been running their Canadian operations up until now, but he steps into their COO job, and he'll now have a chance to basically tell his story to investors, because there's only a handful of banks, obviously, in this country compared to the United States, and there's a lot of attention on all the senior leadership at all these players.
To the point that you've been making, TD Bank has a massive U.S. branch network, and also just over a year ago closed an acquisition of a United States-based investment bank. What does this all mean for their presence in the United States in the heat of this investigation?
It's a great question, Shonali, because you'll probably recall as well, when you were very busy covering the uncertainty in the regional banking sector, there was a deal on the table between TD and First Horizon. They were hoping to come together. That would have given TD an even bigger presence in the United States, but that deal ultimately fell apart. They said it wasn't because of the worries happening at the time in the regional banking sector. They just didn't have a timeline on when the regulatory approvals would come. But given that they had that misstep, and now they are still navigating this one, there is a question about what TD's footprint will look like over the next decade and what regulators will allow them to do. So immediately some people thought, well, if you're taking someone who was running the Canadian operations and putting them as the successor in the CEO job, does that mean there's a shift away from the United States? Bharat Masrani was asked about that from analysts today. He said, no, that is not the plan. But I think people are still going to be very curious to know what the longer-term plan is for TD when it comes to their operations in the United States.
Jon, thank you so very much. That is Jon Erlichman in Toronto. And coming up, a real estate developer behind New York's luxury condos is setting sights on Miami Beach. We're going to talk to Miki Naftali, the CEO of the Naftali Group, next. And before we let you go to break, we're going to take a check on these markets, because the S&P 500 is at session highs, more than 100 points higher than where we closed yesterday. This market has just been on a tear since we've seen the really fallout from that rate-cutting decision by the Federal Reserve. Even with the market closing lower yesterday, you are now seeing a firm bid and a lasting bid throughout the day in this market. This is Bloomberg. This is Bloomberg Markets, and I'm Shonali Basak. A New York City real estate tycoon has set his sights on Miami Beach. And a change in interest rates could goose real estate markets, but how much? For more on this, we're going to bring in Bloomberg Markets correspondent Abigail Doolittle and Miki Naftali, the chairman and CEO of the Naftali Group, a New York and Miami-based real estate development firm. You know, we are talking to you from New York. We're going to want to talk about that New York-Miami dynamic. But, let's talk about the key issue on the table. It's the moment. The moment is here, that 50 basis point rate cut. But how low do rates really need to go to really create a significant lift in this market?
I think we're already there. I mean, we were expecting to see the rate cuts for a while now. And I think we start to see, and the movement is towards reduction of rates in the next 12 to 24 months. So buyers are starting to be excited. We are excited because we borrow a lot of money to build those buildings, and it's very meaningful for us.
So, Miki, you're involved in the super high end. You have 3 projects here in New York and 1 down in South Florida. Super, super luxury, beautiful product. I imagine that you are catering to a real high net worth individual. So does it even matter if rates are going down for your carrying costs? I'm sure it's helpful to you, but how many people are buying in cash?
Sure. So the top end of the market, 20 to 50 or $100 million, a lot of them are buying cash. But we have a lot of apartments that we are selling between 2 to 5 and even under 10 million. Those buyers are mortgage sensitive. And it's kind of interesting. I mean, we see more and more interest, and and buyers start to feel that we're going towards the right direction and they want to buy.
So what is the real occupancy rate on luxury residential here in New York? Because, of course, there's Billionaires Row right out here on 57th Street, but there's certainly speculation that a lot of those buildings are empty, maybe even some of the buildings on the Upper East Side that are expected to be high end. Are you seeing that at all?
So occupancy depends. So buildings might be completely sold out, but some of them are, most of the residents are either foreigners or people that, they live outside of New York City, and they use it as a pied-à-terre. We focus mostly on projects and buildings and buyers that are either true New Yorkers or they live outside of New York, but they spend a lot of time in New York. And our buildings are pretty full, all year round.
How do you make the contrast here between New York and Miami? Of course, there has been a lot of migration in recent years, particularly in and out of the pandemic. You have told us before that people are paying $5,000 a square foot in Miami Beach. How does that compare to what you're seeing in New York?
Right. So, again, there is only a very narrow segment in Miami, which is Miami Beach on the sand, what I call when a building is on the sand, right? This specific segment, there is a very low inventory, and you see 2, 3 very high-end projects branded that are getting the $5,000 a foot, okay? Very difficult to get it in New York. Still, we can get it in New York, but very surprising for Miami. It's unheard of. 5, 10 years ago, $5,000 a foot in Miami, absolutely not. So it's interesting. The majority of the product in Miami and South Florida is trading more sub $2,000 a foot. So.
In terms of Miami, there had been some talk, I think, in fact, Shonali, that Ken Griffin told you not so long ago that it's the new Wall Street or the new New York. Do you agree, or is New York the capital of the world? Not to put you against Ken Griffin.
No, I understand. But look, I think there's a lot of wishful thinking, and it might happen. Definitely not. It's not here at this moment. New York is very strong. I think we all see when we spend time in New York, everything is busy, streets, restaurant. Try to get a reservation in a restaurant in New York. Miami is great, is strong, but it's going to take, and it got to a point of like no return. People live in Miami all year round, but it's not New York yet. It's hopefully it's going to be there.
Well, one thing that New York is not right now is hot in terms of office buildings. That's the part of commercial real estate that's underwater. What about, there's so much talk, and I know that you actually have experience doing it in terms of converting office building into residential. Can you do that at the high end?
So yes, you can. I mean, I will give you one example. I converted between 2004 and 2007, I converted the famous Plaza Hotel. It wasn't an office building, but it was a hotel, right? From 862 rooms to mostly a very high-end residential at the time. Very difficult to do. Very difficult to do. Office buildings, usually they are very big. They're too big for residential. Every residential apartment, every bedroom has to have what we call light and air. And people need to be able to open the window and to, you know, so it's very difficult to convert those buildings. And without any additional support, it will be too difficult to do it.
You had mentioned that interest rates really do make it different for you because you are putting so much investment into these new buildings or older buildings in a lot of manners too. What were you delaying until this point? What can you tell us about what to look for next until what you're going to put money to work for?
So I wasn't delaying but we were very selective in the market because it was and it's still difficult to get construction loans. We were lucky enough to close over $800 million last year and $360 million this year, but it's a difficult market. I think it will be easier in the next, again, 12 to 24 months. We are always looking for the right opportunities, and opportunities are really a reflection of our buyers and our residents. Wherever they want to live, wherever they want to rent apartments, that's where we want to be.
Miki, please come back to us for your next big project. Of course, that is our own Abigail Doolittle and Miki Naftali, Chairman and CEO of the Naftali Group. Before we let you go, check on these markets. What a day. You have seen just that rally continue on in the S&P 500. We're now at 57.22, even higher than that. The NASDAQ 100 up almost 3%. And the two-year yield nice and steady, 360. I'm Shonali Basak. That does it for Bloomberg Markets. Keep an eye on these markets through the close. It looks like we're holding, but man, have we seen days that we've had volatility. Perhaps some of that is gone. This is Bloomberg.